All right. Hello and welcome, everyone. Welcome to the second iteration of the 2024 webinar series. We're in kind of a bi-weekly webinar series iteration right now. Again, my name's Eric Wilson, and we're going to get started in just a minute. I can see the room's filling up, but just want to give people a few minutes to kind of gather. We took a lot of feedback from the last webinar that we did, and we realized that we wanted to just kind of kick it off with a another fundamentals syndications fundamentals webinar. So today we're going to be going back to some of the basics, some of the foundational topics that we've been talking about a lot in our newsletter, and different video series that we've been putting out. But I think that this is going to be a really good session for even experienced investors just to have a good refresher on some of the key concepts and key things to look at when you're looking at different syndications in the market. So we'll go ahead and jump right into it. Now, I want to cover some of the things that I hope you get out of this webinar. And the first one is that I would like to, hopefully by the end of this webinar, would be able to analyze passive real estate investment opportunities to find the best fit for you. And that really, that covers a wide range because it's very much a personal decision about what sort of investment you're going to include in your portfolio. What makes sense with your goals. We've only got an hour here. There's obviously a ton that we can go over, but I'm going to try and give you the best groundwork and hit on all these high level topics so that you can do some further digging and dig into areas where you need a little bit more attention prior to making your next investment. Hopefully, by the end, you'll be able to understand the analysis that you need to make smart real estate investment decisions as a passive investor. Again, going back to those topics that we're going to gloss over a bunch of topics in this webinar. We're going to dive into some topics that you may not be familiar with. So that's going to tell you that you need to revisit that topic and spend a little bit more time in there before you make an educated decision. And this is kind of a general statement and a note for myself. I'm going to try and not sugarcoat anything or overcomplicate the process. I want to give you guys a very blunt, honest, and just good overview of what the syndication process looks like, how we operate at Freedom Venture Investments, and how you guys can leverage our experience to make better investments for your own portfolio. These are some of the topics that we're going to be hitting on today. Again, the basics of real estate syndication, discussing who those key players are in the process. Really important topic, the legal and regulatory framework. So how do you stay compliant as a GP, but also as an LP, making sure that you're investing with the GP who knows what they're doing and they have, all of their I's dotted and their T's crossed when it comes to their legal and regulatory framework, discussing the syndication process, and then we're going to go into actually evaluating opportunities. What should you be looking at when you're evaluating different sponsors, looking at the market, measuring returns, and also what really impacts your return profile? So when a sponsor puts a packet in front of you and they show you the projected returns, what questions should you be asking that could affect those returns? And what sort of scenarios do you want them to show you in your upside and downside cases to make sure that you have all the information to make a knowledgeable investment. And then we'll wrap up this webinar by talking a little bit about Freedom Venture Investments. We'll spend 5 minutes there just to bring it all together and talk about some of the opportunities that we have currently. So when you look at passive real estate investing options, we like to look at it as four separate quadrants. And I'm sure you've seen diagrams like this before, but the way that we've separated it is that private equity is the one that is for stability and growth. You can see private debt, and this is for stability and yield. This would be your private funds, your privately held notes, your mortgages. This is if you're making a private loan onto someone else's project and you're secured by that mortgage, that would be the private debt. And then something that a lot of people are really familiar with would be public equity. So equity REITs, management companies, these things are traded publicly on the market. So you can still get some, seriously strong growth, but you also get the liquidity potential. With that liquidity, though, you sacrifice some of the stability that comes from the private markets. And then the public debt options, such as your mortgage-backed REITs, mortgage-backed securities, things like that. The area we're going to spend our time today discussing is really in private equity real estate. That's where we spend the majority of our time. We do some private debt investments, but the majority of our focus as a company is in private equity. So that's the expertise that we can really speak on, and that's what we're going to focus on in this webinar. A lot of companies listed up here. Just want to go over a few of the ways that you can access private equity real estate. The two most common ways are through syndications and funds. Syndications is what's going to be the focus of this webinar today. But the different types of companies that you can invest with all come with different pros and cons. You can have a local sponsor, so someone who's in your market. Maybe you know them, they're part of your community and they're doing a local real estate development project and they're bringing in maybe a couple people to be silent partners on their project. That'd be an opportunity for you to invest alongside your neighbor. Mid-sized private equity firms, this is where Freedom Venture lies. Significantly, larger than your local sponsor, but also significantly smaller than the Blackstones and Brookfields of the world. And that would be your large private equity firms. Blackstone, Brookfield. I mean, Blackstone has over $1 trillion in assets under management. Brookfield, 900 billion. So these are huge companies, massive amounts of capital. And also when they invest on deals, they're not buying, smaller projects. They're investing 100 million, 250 million, sometimes much, much more than that at a time. And then you also have options for crowdfunding. Crowdfunding allows retail investors to invest as little as maybe $1,000 into projects. Some companies that offer those are like Fundrise, CrowdStreet, Realty Mogul. Some of these are set up as private REITs, not necessarily private funds or syndications. A lot of different options there. Again, pros and cons to all of these. We're a mid-sized private equity firm, so we're large enough that we have access to really high quality, institutional quality projects, but we're also still small enough that we can meet, we can sit down, have a lunch, and you can get to know us. A couple of the key players in a syndication or private equity fund. You're going to have the active partner. So this is the person who goes out and finds the project. This is the general partner, also known as the sponsor of the project. They're the operating partner, and they're also the one that controls the property and all of the entity operations. So they're the one that creates the business plan, finds the property, raises the capital for this project, and they make all decisions with regards to when it's appropriate to dispose of the project, issuing out investor distributions. All that stuff is determined by the active partner. Then you're going to have the passive partner or passive partners, and this is known as the limited partner. This person is also a silent capital partner. So typically they're going to have none or very limited decision-making abilities in the investment. Most of the time, they're just there to provide capital and receive their portion of the profits from their investment. And the two types of passive partners that I'm sure you're familiar with is the accredited investor and non-accredited investor. There's a few more types that we'll discuss a little bit later, but these are the two primary types of investors that I know are on this call and that we primarily work with at Freedom Venture Investments. Some of the benefits, why do people invest in private equity real estate? It's a way to diversify your portfolio. It can be a reliable stream of income. It's very often an inflation hedge, provides a tremendous amount of tax efficiency, and you can even amplify that tax efficiency by the way that you invest. Offers high absolute returns. So absolute returns, meaning once you consider all the factors such as your tax efficiency, the risk-adjusted returns, real estate has traditionally offered very high absolute returns. And it's also a way to reduce portfolio volatility. We all know that if you're 100% allocated into the stock market, you are at the whims of the stock market. Wealthy investors do not solely invest into one asset class. They diversify their investments so that they have a consistent stream of cash flow appreciation, the right mix of risk and return that makes sense for their goals. And now the two ways that we already mentioned that you can access private equity real estate is through a fund, which would be a grouping of multiple properties within one investment. And then there is a syndication, which is one investment onto one property. Again, pros and cons to both types of investments. It's very much an individual decision. You can also do both. No one says you have to be stuck into I'm a fund investor or I'm a syndication investor. I like to equate this selection as choosing between investing into a mutual fund or picking and choosing individual stocks to invest into. Maybe new investors might feel more comfortable spreading out their risk into a fund situation once you are comfortable with analyzing properties, analyzing sponsors, the market, and the specific deal metrics that you need to understand, maybe you're at the point where you can start picking and choosing syndications and putting your capital onto specific projects that you believe are winners. Why would someone invest into a syndication? It makes a lot of sense for both the GP and the LP, and there's different benefits for both parties. Some of the benefits for the investors, so the LP part of the equation, you get access to larger deals that you would not necessarily be able to access by yourself. You get to diversify some of your risk. And also you get the benefits of the expert management. So let's just say if you had $500,000 to invest, you could go out and you could buy a $500,000 property, you could manage it yourself, and maybe you'll have a great return on that property. But maybe it might be better for you if you take that $500,000 and spread it across five separate syndications, leverage the experience of professionals that do this day in, day out. And you may have maybe two of those properties underperform and three of those properties overperform. But you're spreading out your risk and you're deferring the expertise onto professional managers. The benefits for the GPs, so a company like Freedom Venture, it gives us access to capital. So it allows us to leverage more capital and do more deals than we'd be able to do by ourselves. We can expand the portfolio, again, breaching into new markets, again, faster, amplifying our own capital. We always invest into all of these projects, but bringing in outside investors and doing this together allows us to do more deals and leverage our portfolio and get into new markets at a faster rate. And we're also incentivized to make sure that these properties perform at their highest level. Normally, most GPs will have some sort of a hurdle that they need to reach before they can participate in their outsized returns. Maybe that's 8%. It's going to depend on the investment, but a GP is going to want to make sure that you get your return and you get your preferred return hurdle first so that they can participate in their upside, in their promote. Few of the property types that we discuss for commercial real estate investing and in syndication specifically. You've got the four main food groups. Those would be office, retail, multifamily, and industrial. These are the four primary property types in commercial real estate. But then you also have a lot of different subsectors and different property types like land, mixed use, special purpose, hospitality. You can invest into healthcare, self-storage. There's a lot of different types of asset classes. And then each one of these, property types, multifamily, for example, you could say that build for rent is a product of of the multifamily category, but it also doesn't fit necessarily into that perfect multifamily box. It's a subsector within the multifamily asset class. We are going to spend our time talking today about multifamily because that's what we do primarily at Freedom Venture Investments. And I know a lot of people on this call today are multifamily investors. So, real quick refresher, what's a multifamily property? It's something that qualifies as two or more residential units, 2 to 5 being the small multifamily, 5 and above, commercial multifamily assets. Your tenants are individuals and families, so you have a diversity of tenant base rather than maybe a retail building and you only have one tenant. But with that retail building, maybe you're doing a triple net, it might be a little bit less management intensive. Multifamily is generally a more management intensive investment, but There is also a lot of upsides to multifamily. It's traditionally been an inflation hedge because of those short-term leases. We're able to renew those leases every 6 to 18 months. We're always having tenants turn over at different times throughout the year. So that leads to having stable cash flows. We're not having big periods where our occupancy drops down significantly. We shouldn't, at least. These are some of the main property types. We focus a lot of our attention into the garden style apartments. You've seen these on our site. You've seen us invest into these. These are your 2 to 4 story buildings. They can be wood frame construction. They can also be CVS. These are just guidelines. These are not hard and fast rules for any one of these categories. But you'll see these garden style communities and suburban communities. A lot of these communities come with lifestyle amenities. Very popular product type. Then you have mid-rise, so 5 to 9 stories. Maybe it's steel frame, 50 to 200 units. And your high-rise buildings, 10 plus stories, steel frame, again, in urban infill. Not all multifamily is created equal. We have a classification system for multifamily investments, and each different type of classification comes with different opportunities, different risk profiles, and different business plans that we'd be looking to execute by acquiring one of these properties. A Class A property, for example, that's your new construction, first class amenities, and market rents that are at the top of the market. Class B is where we spend a good amount of our time investing. We like this classification. Um, 20 years or newer, slightly dated, but not, wearing down. They might have been recently renovated with a standard amenity package. So not a ton of frills with these Class B apartment buildings, but there's opportunities in Class B apartment buildings. Maybe there's deferred maintenance. Maybe there's, an owner that has owned the property for 20 years and they haven't been raising rents. So that would be a low-hanging fruit for us to market, bring those rents up to the market value. Um, and then there's also you have your older properties, the Class C properties, 30 to 50 years old, limited or no amenities with these properties. We have some of these in our portfolio as well. There's always a place for these in a portfolio, just a different type of business plan. You're not going to get the top of market rents with these products. Serves a different tenant. But again, there can be a place for it in a portfolio. We have a somewhat unique way of measuring risk and return in private equity real estate. This is just a very basic diagram to show you where we plot these along the graph. Core would be your stable properties, cash flowing assets. Core Plus is still a stabilized asset, but there's a light room for improvement on those properties. Value add projects are projects that need a significant amount of renovation. There's something wrong with these properties when we're going in, and we're going in with the intention to improve these properties and add value to what we're acquiring. And then you have the highest risk, highest return opportunity in the opportunistic projects. That can be your development projects, your complete redevelopment projects, projects that they either have some serious issues or there's a lot of work to be done to get that up to where you want to hit your target returns. Again, just some loose guidelines. None of this is hard and fast, but to show you how return and risk go hand in hand, maybe by returns, I would expect it to go up as you're taking on more risk with these projects. So as you get to a value add, you might be hoping to achieve a 13 to 17% return, opportunistic, 18% plus, again, for that assumed risk that you're taking on. And risk goes hand in hand with the leverage that's on these properties. If you are a core investor who wants to protect capital, who wants to be in a secured spot and receive your regular cash flow, you're going to want to not have a lot of leverage. You might want to be in the 40 to 45% range. Whereas if you're doing a value add project, you might be pushing the leverage up a little bit, 65, 70, 75% maybe. That'd be over levered in my opinion, but these are just different scenarios and different types of investments that we can make as passive investors. The investment cycle, we're going to talk about a value add investment life cycle. This would be very different if this was a development project, but the basics life cycle is it starts with the deal sourcing. And you have to go through underwriting. The GP would raise capital for the project and then go through the acquisition process. Once they actually own the property, the LPs and GPs own the property, the GP is going to execute the business plan that they've put in place and make those value add improvements that they've mentioned in their offering memorandum. Then the property is stabilized and you're going through operations. There might be a refinance opportunity depending on how long you're holding this property. You've already made your improvements, you've brought the rents up to market, and now you're in a position that you can maybe take out some equity or refinance, change your terms on your existing loan. And after you've held on to the property, maybe seasoned it for a couple more years, you would look to dispose the property, go through some sort of an exit strategy, whether that's moving into a 1031 or outright sale, whatever the business plan is, that's the point that you would be looking to distribute the proceeds from sale. So if you invest as a passive investor into a project and it's a value add project, these are the different phases of that life cycle. This could be over a 5-year span, a 7-year span, a 10-year span. It just depends on the investment that you're choosing. Now, before you make any investment into any sort of syndication or fund, you have to understand what the structure is that you're investing into. What are the LLCs? What is their responsibility? Why am I investing into this LLC? Where's the exposure going to come back to me? Those are some of the questions that you want to be thinking of when you're looking at the entity structure of a syndication. Some of the common legal entities would be an LLC. We prefer to use LLCs at Freedom Venture. There's a lot of advantages that we find by using an LLC, and that's what we've shown in this diagram here, just one scenario, and I'll walk through this in a second. Sometimes you might see a partnership, and that's really where we get the term of general partner, limited partner when we're discussing these. Technically, in an LLC, there isn't a partner, general partner, GP, LP, but we have managing members, and that's, we still use the same terminology. And then as part of understanding what the structure is, you have to make sure that you're receiving the necessary documents and reviewing them from the GP, including the operating agreement that explains how this entity is going to be managed, and the subscription agreement, which is what you're ultimately signing and agreeing to. So this is just one example of a structure for a syndication. Not all syndicators follow this model. You can have different variations, different flavors of this, but this is a somewhat common structure. In this scenario, you have a holding LLC. This entity actually takes title to the physical real estate, 100% owned by one owner, and that owner is the Syndicate LLC. That Syndicate LLC, this is the most complicated entity because this is where both the GP and the LP are contributing capital. This is where the operating agreement is going to be contained that stipulates how the flow of funds are going to be handled. So this is the LLC that you want to pay the most attention to when you're reviewing your entities, but you also want to understand how the GP is getting their ownership stake. And they may opt to go for two separate LLCs. You might see that a lot. And the reason that they do that is to separate how tax treatment is handled between their two entities. You might see a GP LLC, you may not see a GP LLC, but especially if there's multiple GPs involved, you're going to see a GP LLC that determines how their profits are separated between amongst those GPs. That's where the GP actually owns their membership interest in the property, in the project, in the syndicate LLC. So the carried interest or promote travels up to that GP LLC and distributed further amongst there. And then there may be a separate management LLC, and this is where they would collect any management fees. And this would typically be taxed as an S corp. They might elect to do that in the future. But this property does not actually hold physical real estate, or this entity, I should say. Yep, like I just said, the holding LLC holds title, syndicate LLC owns the holding LLC, And this is where we come in as GPs and LPs into the syndicate LLC. GPLC determines how profits are distributed amongst the GPs, and then the management LLC, again, just for maximizing tax efficiency, it may be something that you see, and I want you to be aware of it. Some of the regulatory agencies that we have to abide by. We have the governing body that we have to conform with, and that is the Securities Exchange Commission. Everything that we do as a private equity firm has to be in line with SEC's most current regulations. So we have SEC attorneys that are on top of that and reviewing that with us on a very regular basis. It's important to understand why certain offerings are even in existence. The Jobs Act was a provision that allowed general solicitation and some of the regulations that we currently are able to utilize that occurred back in 2012. So just some important provisions that you should be aware of. State security laws, so blue sky laws, as we call them. Individual states may have their own specific laws with regards to offering these securities, offering private investments. And that's to protect the investor. That's why individual states will have their own individual laws. It's a means to protect investors from their state and protect them from potential fraud or any sort of issues that you may run into with private investments. The importance of compliance can't be overstated. You get in serious trouble as a GP for violating any of the laws that are in place by the SEC. And also as an LP investing into these deals, it's also your responsibility, our responsibility to do due diligence on managers that we're considering investing with and make sure that they're abiding by these laws so that none of this backlash comes back to bite us. We can do as much as we can. And again, it's for investor protection, why these rules exist. So some of the best practices that firms should be making sure that they abide by, engaging legal experts, attending regular training, and making sure that they're up to date with the most common laws. And I think that applies to LP investors as well. You should be very aware of the most current updates and everything that's going, if there are any changes currently happening. Syndication agreements and documentation. So the role of a syndication agreement, this is what you're actually going to be signing when you're committing capital into a syndication. You're going to be reviewing what's called a PPM, and as part of that PPM, there's going to be a syndication agreement, and that's going to detail all of the specifics about what you're actually purchasing. So for an LLC investment like what we currently offer, you'd be purchasing units of that LLC. And that's what this syndication agreement is allowing you to do. Some of the other key documents that you'll see is the operating agreement, and that's the operating agreement for the syndicate LLC that we discussed. Partnership agreement, of course, and the subscription agreement. Again, best practices, both for GP and LP. Can't say it enough. Consult with legal counsel. When you're reviewing these PPMs, they're intense. There's a lot of legal language in these PPMs. I always recommend people review them with their own attorney and CPA so that they understand all the implications for their specific individual situation. The PPM, that's what we put in front of investors. That is the document that contains the subscription agreement, the operating agreement, all of the details of the investment. These are big documents. They're big legal documents, maybe 150 pages in length at times. We can't go over all the components of a PPM. That's something for you to do in your own time with your own attorney. But some of the key sections to be aware of in a PPM, things that you should be looking for if you're going to be looking at certain sections, you're going to see an investment summary. You're going to have all the risk factors listed out, the terms of the offering. So how long is this offering for? What's the hold period? Who's the management team? What's their background? All of this stuff is going to be into a PPM, as well as basic financial projections and use of funds. Again, that stuff is going to be in the PPM, but there's going to also be a lot of supporting documents, financial projections, Excel models, offering memorandums that are going to support the PPM and provide more color to what you're investing into. We discussed briefly already that there are accredited and non-accredited investors. Accredited investor is someone as an individual earning over $200,000 per year or jointly with a spouse over $300,000 per year for the past 2 years with a reasonable expectation that that will continue into the future. Or you can also qualify as an accredited investor by having a net worth exceeding $1 million, excluding your primary residence. All other investors that fall beneath those thresholds would be considered non-accredited investors, and there's still investment opportunities in private equity real estate for non-accredited investors as well. You also have sophisticated investors and qualified purchasers. These are investors with their own set of requirements that we work with. Different sort of situation for those investors. Those investors typically know who they are. Compliance in investor solicitation. Again, depending on who the investor is and what we're offering for an investment, what we're offering for an investment dictates who we can speak to about the investment. So a lot of that will come down to if it's a Regulation D investment, and it's a Regulation C, Rule 506C under Regulation D, then we can generally solicit to accredited investors. If it's under Regulation D 506B, then we're allowed to again solicit to accredited investors, but we're allowed to also accept up to a limited number of non-accredited investors. And I think that number is 35. So now we're going to dive into a little bit more details as to actually evaluating opportunities. So everything up to this point was very much just a base understanding, quick overview of what syndication is. Now I'm hoping to offer a little bit more, practical skills that you can take away from this webinar and utilize when you're looking at your next few investments. One of the first things that you're going to want to consider when you're looking at a potential investment is the sponsor. So who is the sponsor? What's their background? And are they going to be capable of executing the business plan that they've put in front of me? And there's a couple things that I like to look at when I'm evaluating sponsors for a potential investment. And that would be, do they have institutional background? That's not a requirement, but that can sometimes be something that really elevates their knowledge about, a particular asset class that they're investing in. It comes with a level of professionalism and some skills that you may not be able to get, if they just have some schooling under their belt, if they don't have the institutional background. That's just something that I like to see. Again, it's not a requirement. Oftentimes, if you're not seeing the institutional background, you may see that they have some experience working with a small private equity firm. And sometimes this can be even more valuable than having institutional background experience. And that's because when you work for a small firm, you really touch every different part of the investment life cycle. Whereas if you're working for a large institutional investor, you may have one specific task that you work on, and you have an entire department, entire team that can help you and support you, and different people in different departments that handle different things. So if you have an institutional background, if the sponsor that you're considering investing with has institutional background, that can be great, but it can also just mean that they are really good at one specific part of the investment life cycle, and they may not have that all-encompassing experience. So I like to see firms that include some institutional background, but also some smaller private equity experience. And then you can't invest with someone unless they've had individual deal successes. So you want to be able to have them show you that, they have had success in the past, and it's in the same sort of type of property that you're considering investing with them on this current deal. So this is a basic, just cutout of what a track record may look like, and then you can dive a little bit deeper into the details with that sponsor. Some of the skills that you might want to look for in a sponsor: acquisitions and development experience. So that is going to be very specific to the type of business plan that you're currently looking at with them. If someone has experience in acquisitions multifamily, that doesn't mean that they're going to be able to manage an entire development project from start to finish. And likewise, if someone has development experience, but they've never um, acquired an existing asset and executed a value add plan, it may not go both ways. So you want to make sure that they have acquisitions experience if you're looking at an acquisitions investment, and make sure that they have development experience if you're looking at a development project. You got to make sure that they're able to be efficient with their asset management. This one's really crucial. This drives their ability to execute the business plan, their ability to stay on budget, on schedule, and follow through on the things that they laid out in their business plan. That's what asset management's all about. It's about managing the asset and making sure you can execute the business plan and make sure you can adjust to new circumstances in the market. Someone on the team has to have construction and redevelopment experience, especially if your project is a heavy value add project or if it's a development project. You need to have someone who is in depth in that field. If someone was a broker for an institutional company and they manage different listings and they're doing their first project and as by themselves, and it's a heavy value add project with a really big rehab budget, you're not going to trust them to be able to manage that budget and do all the things that they need to do. Maybe the most important one, actually, I would say definitely the most important factor that we have here, geographic presence. So someone who has local market knowledge. That means that they have intimate knowledge of the market, what's going on, who's buying what properties, what sort of local regulations do we have to abide by with regards to zoning and all that good stuff. And they also have the local relationships. So that means relationship with brokers, property management, construction teams, their ability to get in with these local people near the subject property that we're considering is crucial. It's real estate is not an industry that you can just pick a market, jump into it, and hope to be successful. You really have to have that local presence and a deep understanding of the market. And then I also like to see product type specialization. So I think it's better generally if investors work with sponsors who are focused on an individual product type, meaning property. So whether that's multifamily, a certain type of multifamily, maybe they're retail specialists, medical office specialists, whatever their niche is. I want to see a sponsor that is proficient at executing in their niche, and they're not just kind of shooting from the hip and investing into everything that they come across because it seems to be a good deal. I really like to, I've seen this historically. You see the best deals with sponsors who know what they're doing in one asset class and they can do it over and over again. If you're comfortable with a particular sponsor and you're on their list and you're starting to see opportunities come through to you, that you really have to understand how to do market analysis for yourself. Listen to their words, listen to what they're saying about the market, but also understand that you need to do your own research. And that starts by understanding, first of all, where are we in the real estate market cycle? And this is kind of the basic the four quadrants that you'll see in real estate. I'm sure you've seen diagrams like this before, but real estate generally has gone up over time, but it has not gone up in a straight line. We have these ebbs and flows throughout history, and there are different times for different business plans. For example, if you're doing a development project, and you want to be timing the market, you want to be selling this property as soon as it's finished, then you'd want to be coming out of the ground and getting your certificate of occupancy as close to this market equilibrium dot here in the middle as possible. If you undershoot it, you're missing out on some of the upside. But if you overshoot it and where you start to enter into this hyper supply phase of the market, then you start to see that there's increasing vacancy, and this is where rents are starting to drop and there's more supply in the market than there is demand. But as it comes back around, then there's more opportunity for development as the market rebounds. So, different markets can be in different phases of the cycle. Different product types can be in different phases of the cycle. So again, that comes down to understanding your niche, working with a sponsor who knows their product type intimately and knowing their market intimately. Because the headlines that you read on Globe Street and all the other news sources out there, um, they're national headlines most of the time, unless you're diving in deep. So they're not going to tell you the whole story. You need to do some research and figure out what's going on in the market and see if it's a good time for you to invest in that market, in that asset type. So the purpose of market analysis is really to answer three questions. It's if we should invest at all, is capital available? And then, where are we looking to invest if we are going to invest? What region of the country, what state, what local neighborhood are we looking at? And then what product type would be successful in this market? Is it office? Is it multifamily? And then taking a step further, if it is multifamily, what type of product would be successful? Is it a luxury product, a workforce housing, an affordable product? Those are all things to consider when we're doing this sort of market analysis and weighing the different opportunities that we're seeing as passive investors. Some of the key components that go into doing this market analysis is economic indicators, so GDP growth, things of that nature, demographic trends. So what we're really looking at with demographic trends, things like net migration. Are people coming into this area or are they moving out of this area? And then supply and demand dynamics. What sort of supply is in the current market? Are people, again, moving into this area? Is that increasing the demand? What's happening in this local market? And understanding that real estate is local. You need to understand the regional and national trends, but you need to really dive into the micro analysis and understand the local market conditions. Like I said, some of the economic indicators that we consider are things like employment rates, GDP growth, and the big one that people are really talking about, have been talking about for the past 24 months is interest rates. Interest rates really dictate a lot of the success of different business plans for real estate syndicators. And understanding what's happening with interest rates and how that aligns with cap rates is really important to understand for investors, but that deserves its whole webinar all by itself. Again, the importance of demographic trends, something that I like to boil this down to is net migration. That's what I really want to be looking for. Is the population growing? What's the age distribution? And if people are moving into this area that I'm looking to invest in, what sort of income level are those people? Who's coming in and what can they afford to live in? Tools and resources that are available to you. There's census data that's readily available to everyone. Market research reports are very available that are for free. A lot of different large institutional brokerage companies put out consistent market research reports that can really help you out. Um, and then you can also have paid platforms that most companies like us, we spend a lot of money and invest in our data because it's really important. Just some of the info that we look at when we look at market analysis. Again, looking for that net migration. I'm not going to spend a lot of time here. Supply and demand all comes down to supply and demand at the end of the day. You don't want to be investing into an area that is saturated with supply. Or if you look at the development pipeline, it may not be saturated today, but it has a ton of units coming online within the next 36 months. So we know that supply is going to outpace demand within the time period that I'm looking to hold a certain property. So these are things that you can do in advance prior to making an investment to make sure that you're as successful as possible. Yeah, looking for the supply in the market is very actually easy to find. There's a lot of different data companies that provide this information. And you can look at the development pipeline, pulling public records, seeing what's coming online, seeing what sort of planned properties are coming for the market, seeing what's under construction. All of this information is very readily accessible. When it comes to figuring out the demand, though, that's a little bit more involved. There's not just one place to go and look for demand. But there are certain things that we can look at, such as employment trends, migration patterns, um, income level growth, population change. That can also help us dictate the demand occupancy levels as a big driver. So we can get to a number that we can figure out. Here are some resources that you can go out and purchase. As a limited partner, as a passive investor, you may not want to spend the capital for all of these, but it may be worth it to, if you're focusing in a particular area, to spend some money and dive into a particular market. But there's also a lot of free info available, and your sponsor that you're considering investing with should provide you with all the necessary resources from these paid sources to be able to give you an educated and informed decision. Like I said, these are just some of the free data sources that are available to you as well. When it comes to financial analysis in real estate, there are some basic concepts that you really have to understand. You have to understand how to do income assessment, expense analysis, and then calculate the cash flow. Again, this is all stuff that's going to be told to you by the sponsor, but it's important to trust but verify. Be able to have the knowledge and expertise to look at their due diligence documents and be able to plug and play into numbers into an Excel model that maybe they've given you and tweak them around and see what's going to actually impact your overall returns. It's important. It can't be understated what the importance is for these sort of decisions that can help you determine the viability of this investment, also determine the level of risk associated with this potential investment. There are some key metrics that you should be very familiar with and comfortable with prior to making any investment. Net operating income might be one of the most important metrics that we use as investors, and that is your revenue minus expenses. At the end of the day, what does this property produce for income? Now, this does not include any capital expenditures, debt service, or taxes. This is just your revenue minus your operating expenses. Cap rate is actually a little bit it's I'd say it can be misunderstood and misinterpreted by many because at its face value, it's a measure of return. It is the NOI divided by the property value. So if we were to buy this property all cash, what's the expected return that we could anticipate? But more so than a measure of return, it's a measure of risk. It's a measure of viability for an investment. It's a tool for measuring properties versus another property in an area. Cap rates are, again, every metric's important, but cap rates are one that really drives the values for our industry. So it's one that you really need to understand and understand that it is also a measure of risk as much as it is a measure of return. And debt service coverage ratio, I'm sure you're familiar with that. We want to be able to see properties and especially lenders and they're not going to give you a loan on a property unless it typically has a 1.25 DSCR, depending on the product that you're trying to get for a property. But as a passive investor, you want to know the DSCR because you want to know, are we just barely getting over the DSCR? Are we, at 1.26? So we're barely covering our debt service. That may not be a situation that I personally would want to get into. Now I'm going to run through a very quick example of a property just to show how some of these metrics are calculated, starting with the NOI. So very simple. We just take the revenue, subtract the expenses, and that gives you net operating income. And now the cap rate, we can take the NOI that we just took, the $735,000 figure, and divide that by the current list price of $15 million. And that could give us a suggested cap rate of 4.9%. Now, what would happen is if we're in this market and we can say, okay, they listed at $15 million, that's a 4.9 cap. Let's look at other properties in the market. What are they doing? What are they trading at? And we do some research and we find similar properties that have recently traded and maybe they've traded at a 5.5 cap. So now we know there's a market cap rate of 5.5. That's what the market's at. So we're going to rearrange this cap rate formula, and now we're going to solve for property value. And this is called the income capitalization approach to valuing real estate, but it can help us get down to a number that might be more in line with the market. So we're going to take that same NOI figure, and now instead of dividing it by the property value, which was the list price, we're dividing it by the market cap rate. And that's going to give us a potential property value of 13,375,000. And that tells us that maybe this property should be more likely in line with that $13 million figure. And it allows us to do some more digging and figure out why it was priced the way that it's priced, and start to peel back those layers and figure out a reasonable offer, if this is a property that we were interested in buying. Some of the key return metrics that you should be very familiar with as a limited partner, cash on cash. This is your annual cash flow divided by your total equity invested. So this is your pre-tax cash flow. So the ratio of annual before tax cash flow to the total amount of cash invested expressed as a percentage. And then another metric that we use a lot in real estate is equity multiple. You may not see this in other asset classes, other investment types. It will just be expressed differently, maybe as total return. But equity multiple is total distributions divided by the total equity invested. And then we have internal rate of return. And this is the ratio of NOI to annual debt service, indicating a property's ability. Oh, no, that's the wrong definition. That is the DSCR definition. So internal rate of returns, really, it's the discount rate at which this property is producing a return. This formula looks extremely complicated because it is. You really can't solve this by hand. I one time had a professor do this with us, and we had to solve it by hand as a bonus question back in college. And the only way to do it is really by guess and check. You're trying to get a value that equals zero. Luckily, we don't have to do that. Excel makes it extremely easy for us to find the IRR. But I think IRR is a metric that is very it can mislead investors when looking at potential opportunities because a lot of investors don't understand it, and it's extremely heavily influenced by the timing of cash flows. So to show that in a side-by-side example, I've got two investment situations here, both of $100,000 and both with a 3-year hold. In this first situation on the left, we've got year one cash flow of $50,000, $50,000 in the second year, and then 28.5 in the third year. So that gives us an equity multiple of 1.28. In the second scenario, we did the same $100,000 investment, no cash flow in year one, no cash flow in year two. And then in year three, we got back our return of capital, so that $100,000 plus $52,000 in profit. So that gave us a 1.52 equity multiple. This first situation, because of the timing, we got a 15% IRR. So you can see we've returned a lot more capital, dollar for dollar in this second scenario, but we had the exact same IRR because of the timing of cash flows. This investment returned less to us. We got less money in our pocket, but because cash flows occurred earlier in the investment life cycle, we had the exact same IRR as this scenario. So that's the importance of understanding what IRR means and how it is so heavily influenced by the timing of the cash flows. Because you could get two investments side by side, but dollar for dollar, they could be wildly different. And depending on your goals, it may be more important for you to get this bigger payout at the end and not as important to get the early cash flow. Maybe it is, but understanding it is crucial. Separate situation, two investment scenarios again, both with $100,000. This time the investments are starting at different time periods. So year one, making our investment. Year two, no cash flow. Year three, 130,000. You guessed it, total gain $30,000. So that gives us our equity multiple of 1.3. Same total gain on equity in the second scenario of $30,000. But the IRRs this time, 14% in the first scenario, same equity multiple in the second scenario, but an IRR 30%. Again, because of the timing of the cash flows. In this situation, the capital wasn't invested until the second year, and then we got all the return of capital in back-to-back years. That gave us a really, really strong IRR, but at the end of the day, dollar for dollar, the two investments returned the same total return. Now, when you're looking at different investments, you're going to be handed Excel model. You should be handed an unlocked Excel model, and that gives you the ability to go in and play with the numbers. It's going to have all the income projections, the expense forecasts, scenario and sensitivity testing, what if scenarios, and also testing those key variables. LP return targets. So what sort of return targets are you looking for? This is a question that is going to be highly subjective. It's highly up to you, depending on what your plan is, what that, allocation for the capital means to your portfolio. But generally speaking, as risk increases, your return requirements should increase as well. As risk decreases, your return requirements should decrease. It's a less risky investment. Your requirement for a return is going to be less. And then when you're looking at investments, understand what you're investing for. Are you investing for the cash flow, or are you looking for that growth, for that appreciation? Some of the things that are going to vastly impact the LP returns are things like the hold period. A shorter hold period may have potentially higher projected IRRs, likely going to be higher risk, and maybe higher return potential, versus a longer hold period, which could be potentially more cash on cash focused and not as dependent on market conditions. You could ride through a recession in this scenario, potentially. But this is something that you're going to want to see from your sponsors. Scenario analysis, how these numbers are impacted as cap rate expansion occurs year over year, and how many years we hold on to this investment. How does that impact our returns? Leverage. This is a topic that we could spend an entire webinar on, as well as pretty much every topic that we've discussed. But these are two scenarios: 85% leverage and 70%. You can see in the extremely over leveraged scenario of 85%, we only had to put in $3 million versus the 6 million in the 70% leverage scenario, and that amplified our returns to 121% versus 65%. So leverage is a means to amplify returns, but on the downside case, it's also a means to amplify your losses. And that's what we're showing here. It's the same exact investment, same scenarios, $3 million in the 85% leverage scenario, $6 million in the 70% leverage scenario. And this is showing just a 5% market decrease. So for whatever reason, we had to sell this property at a 5% loss. We can see that in the over leveraged scenario of 85%, we lost 79% of our equity versus 35% in the 70% leverage scenario. Now, it's never great to lose equity. You never want to lose a dollar in real estate. But if I had to lose money, I'd rather lose less of it. And I'm just checking the clock. I know that we are tight on time. I'm going to keep going just until we finish. I've got a few minutes here. I've only got a couple more slides to hit on, and then I will be sending out this recording at the end. So if you have to go, pay attention to your email, and you'll get this full recording. Financing terms is another one that's going to impact your return profile significantly. So knowing what the sponsor was able to get for financing terms and how that fits in with the overall business plan is really crucial. If you have a fixed rate, this is a hedge against interest rate risk. Your interest rate isn't going to change, so you've got a fixed rate. So you're not exposed like you would be in a floating interest rate scenario. Floating interest rate, you bear that interest rate risk. A lot of investors who invested at ultra low interest rates, maybe in 2020, 2021, and maybe they're having their loans due in the next year or 2 years, and they're coming out in a completely different credit environment, completely different interest rate environment, and some of their deals aren't penciling at the deals that they were a couple of years ago. It was such an aggressive interest rate increase over the past 18 months. That was very hard to anticipate that. We didn't anticipate that, but we also didn't have any floating interest rate loans that were reliant on it. We were lucky that we were buying properties all cash in 21. So, we avoided that scenario. interest only period is something that you'll see a lot on projects. And this is something that can really amplify your cash on cash returns temporarily because you're not paying down that principal. But you want to pay attention to when that interest only period is and when that's going to start to impact your cash on cash. It could be a long-term only period loan. It could be. But if you're planning to sell your property before that interest only period is up, you want to look at that and have a firm understanding of what that's going to do to your returns once you have to start paying down your principal. And the amortization period, so the shorter the period, the higher the payment. Pretty simple there. Rent growth, something that's going to be in every single model, and really should be broken out by year over year. I don't like to see these models that just have one rent growth for every single year because there's different things that happen year over year. But this is a massive metric that can really impact LP returns. A couple of years back, I remember seeing a lot of different offering memorandums coming my way that were showing double-digit rent growth year over year. And they weren't totally wrong because that's what was actually happening in the market. We saw a lot of markets that were experiencing insane 10, 15% year over year rent growth. But as we know, that's not sustainable for the long term. That was a very short-term period, and they were underwriting to that. So you don't want to be stepping into a deal where operators making ridiculous assumptions and they're saying that we're going to get double-digit rent growth year over year. It's not realistic. It's not going to happen. The standard is between 2 to 4%. Standard, historically speaking, but you have to have data to back up what your decisions are, for that specific property type, for that specific market. You don't just want to work with a operator that's going to say, yep, it's going to grow by 4% every single year. No reason why, just because you want to dive into the details and have a firm understanding of why they think the rent is going to grow. And this is, we're talking about organic market rent growth, not forced rent growth. And this is driven by population growth. It's all the metrics that we just talked about in the market analysis. And doing this, when you're playing with these models, what this is called sensitivity analysis. So you want to work with a sponsor that's going to show you all of the different upsides, the downsides. What you're seeing in their offering memorandum is their base case. It's one scenario, but we all know that once a projection is made, it's wrong. So it's really important to test these metrics, test these variables, and have a firm understanding of, okay, what could happen if this happens? What if rental rates increase by 5%? What if occupancy goes down? And then having a firm understanding of what all of these metrics do and what all they combined, so you can make the most informed decision possible based on what you think the market reality is and what you think is actually going to happen. These are some common variables to stress test. If you've ever seen one of our offerings, we stress all of these. And we always put out upside cases, downside cases, and we always have a narrative as to why we believe that case is our base case. So thank you for sticking with me. I know that was a ton of content. I know I had to rush through a little bit at the end there. But I was just going to wrap it up by telling you a little bit about who we are, Freedom Venture Investments, because I know that a lot of people on this webinar are first-time investors. Generally speaking, on our webinars, we see about 10% brand new people are first time being exposed to Freedom Venture coming to these webinars. So I would love to just give you a quick overview of who we are, and I hope that you found some value out of the topics that we just covered. So Freedom Venture Investments was created by myself, Dave Seymour, and Walter Novicki. We realized a simple truth that we could achieve much more together than we ever could alone. We started by just pooling together our own resources and investing as a team. But again, going back to that LP GP conversation, we can do more by working together. So we started to bring in outside investors, we started to expand, and now we have over 500 partners now invested with us. And every deal, every investment is a testament to the power of collective effort. So this is kind of our mission statement. This is kind of what we're all about. This is what we are. This is who we are at Freedom Venture. Going back to when we were founded, 2019 was when we first started. All the partners have history and track record going beyond that. But Freedom Venture officially formed in 2019. We started with our first real estate fund. We've had a few funds since then. Currently, we have over 350 million investor equity that we manage. We've achieved over a 22.14% average gross IRR, and we currently now have over 1,600 units under our management. These are the markets that we're currently invested in. So we always have boots on the ground expertise. If you're on this call, you likely have a good understanding that we have a strong presence in Florida. We have a southeast hotspot down there. We've got a headquarters down there. But we invest in all of these markets, Texas, Georgia, the Carolinas, Tennessee. But whenever we've invested into these markets and we've branched out into a new market, it's because we've had presence there. It's because that we've worked with operators in that market and we have that local knowledge that gives us an advantage for our investors. These are the current funds that we have available. Three distinct funds, three funds with their own business plan, with their own strategy, their own return profile. Um, the private lending fund, this is our most secured fund. This is a fund that makes debt investments. So we're actually investing into the first lien position, and we're supplying loans to other multifamily operators that we feel confident they can execute the business plan. That's a 9% targeted annual yield, distributes monthly, and that's 25,000 minimum investment. The Balanced Income Plus Fund is one of our flagship funds. 9 to 12% targeted annual yield, quarterly distribution schedule, 50,000 minimum investment. So this is a blended portfolio. This is a fund that has a mix of some debt investments, some cash flowing core plus investments, and then a few development projects as well to give us some of that growth, some of that appreciation. But the main goal of this fund is to have income with some growth upside. And then the Suncoast Growth Fund is the opposite of that. It is targeted on growth with then some income potential. This is a 2.5 to 3x target equity multiple. It's a minimum of 4-year hold and a $50,000 investment minimum. This is a very focused fund on development projects. Again, we're trying to capture the forced appreciation through the development process, and we're trying to grow capital in this fund. And as we discussed in this webinar, and what this webinar was all about, was our syndication offerings. So for investors who like to pick and choose the investments that they place their capital onto, we have asset-specific investments. So instead of investing into one of our funds for a blended portfolio, you can invest directly into a specific property of your choosing, offering a clear view of your asset. And there's different pros and cons, like we discussed. Some people prefer to have the blended portfolio. Some people prefer to have that specific understanding of exactly where their capital is going onto exactly which specific property. So it's a personal decision. No reason you can't do both, one or the other. But these are the offerings available at Freedom Venture Investments. And you can visit our website. We've got a lot of different testimonials on our website, giving their experience, people who have been in your shoes before. Reach out to us. We can set you up with on a conversation with some of our investors. But looking ahead, if you're a new investor, if you're new to Freedom Venture, and this was your first time being exposed to passive real estate investing, apply this to some real world scenarios. Start looking at opportunities. Go into your local community and start expanding your network. Go speak with brokers, investors. Start to work with industry professionals, and always be learning. That's the best advice that I can give you. We constantly are putting out new information through Freedom Venture, through our website, through our affiliate social media channels. So stay on top of all of that information. Try and gather as much information as possible. We always like to say that an informed and an educated investor makes a better partner for us. So we like to work with investors who have done their homework. You can always join a mentoring group or investment group to get some practical experience and some further guidance, or you can visit freedomventure.com/education. This is right on our main website. We've got a ton of resources on there for you to browse through and amplify your learning. If you are interested in scheduling a call, if you're interested in making an investment or seeing what's available, go to our website, schedule a call. You can reach out, email us at ir@freedomventure.com. That's our investor relations email. So that'll get routed to the appropriate team member. They'll schedule a call with you, or just go to our website, click start here, fill out the form, and you should be able to book a call right through the link that we send you. So thank you for your time today. Really appreciate it. And look out for another email from us where we will be sending the recording to this.